Up next, please welcome Alicia Chandler, David Malone, Raul Reynes, and your host, Matt Reynolds.
Thanks everyone again for taking the time and finishing out with us. Obviously the conference, the tone and the reason for it, right, is to bring people together to come up with ideas that you can take home. And like anything else, we probably could have taken each one of these sessions. We could have taken each one of these sessions and turned it into a conference by itself, right? So we'll do the exact same thing with this panel, right? We've got about 45 minutes that he's going to fly by. And what we're going to be talking about today, is really the planning, financial planning, but also just general planning for small businesses, and then the exact same things that you guys can do with your practices. So with me today is Alicia Chandler, who is the CEO of Oak Street Funding. A lot of you folks know who they are. They specialize in funding for practices, advisory practices, accountants, and insurance, right? David Malone's one of our peak folks. Most of you know. David also runs a company called Malone Integration Services and Group. And then Paul Reynes, he was here with us yesterday. Paul's one of our senior tax folks on the Bristol Lane side. So, Raul, what did I say? Oh, I've been yelling at him all morning. I'm sorry. So, all right, go to the next one. All right, so there's a lot to talk about when it comes to just planning for our clients, right? A lot of people who are entrepreneurs, they know what they're doing in their specific area. What our goal is today is really to just walk through really quickly 4 areas inside the life cycle of a firm, right? And what that is the financial planning, which is what I'd say is just building, right? Then you have risk management, which is going to be kind of protecting what you have. There's growth, and then there's succession and exit. So we're just going to touch on each one of those. And what we're going to do is, I feel badly for these guys. I gave them 30 different questions to make sure that we had enough information. But we're just going to talk here. Okay. So, first area is just financial planning and how we work with business owners to help them understand their business better. Right? So, Gail, I'm going to start with you. Right? When we talk about the financial planning aspects for a firm, what does that usually include for your clients?
Well, initially, probably the front and center topics of concern are benefits and tax efficiency. The owners almost always want to maximize their benefits, not necessarily the staffs or the employees, as well as their tax efficiencies. But as we take them through the process of, if you go the route of a profit sharing or cash value plans and benefit plans, that you can give a little bit to the employees in order to get a lot better for yourself. And teaching them or showing them different ways that you can supercharge their savings. So a lot of these business owners, maybe it takes them 20 years to figure it out, how to stay afloat and really start to scale their business. And so they might be in their 40s or 50s or even later before they start finally seeing some nice profit margins. And they've got a lot of catching up to do when it comes to their own retirement savings or their own personal net worth. And so we can take them through the different benefit strategies, as well as making it as tax efficient as possible on the personal side of things as well.
Sure. And I guess part of that is helping them understand the value, not just of employees, but what those employees need, right? So we heard from the previous panel, personal experience of trying to figure out how to maximize what those employees can have, which really helps you find and retain better people. So I think the first question is typically like, how do I afford that? Right? How do I afford giving my employees more when all I'm really worried about today is trying to maximize what I'm making. What's the first conversation you had with them when they walk with that idea?
Similar to previous speaker the other day, it's how can you not afford it? Or you can't afford not to retain those employees. They are going to be the life cycle and the engine behind the growth of your business. And so it's in your best interest to compensate them, keep them happy. As probably everybody in the room knows, HR and replacing employees and retraining them, it's one of the most expensive processes in the entire business. Doesn't matter what kind of business you're in. You're paying someone while you're training them. You're letting them loose to do it on their own. If they screw that up, you got to go back and fix it anyway. So why don't you just do what you have to do to keep the guy or gal that knows what they're doing to begin with?
Yeah. We've had an old mentor used to say, hire slowly, fire quickly.
Absolutely.
Right. So Alicia, on the banking side, right? Employees, I would think that from banking perspective, you're looking at financials, you're looking at what they make, things like that. When you guys are doing due diligence on a team or on a firm, something like that, what do you look at as it relates to the employees and the employee fit?
So I think, to your point, is it's one of the most critical things that we look at. Obviously it's a goodwill business, and the people are what keeps the engine going. And so, if you have a sole owner, or even maybe just one, two or three, we want to see who's behind those people. If something were to happen to that owner, who's going to be able to step up and run the business. We also want to understand if there's any concentration risk. If they have one or two advisors that are handling a majority of the clients and that advisor leaves, what happens to that business? And those are all significant factors that are going to play into our underwriting analysis and the risk of the business. And if we do see that, Matt is one of the biggest producers in the business, and he's not tied in appropriately with, good compensation. He's not tied into non-solicits, non-competes. That's definitely going to be a red flag for us.
Okay. So you have a couple of firms coming together. What do you, and this is going back to you, David, for a second, then back to you, Alicia. What are some of the different types of benefits that you guys are seeing that are retaining these employees? Is it always just, let's maximize the comp?
No, in fact, sometimes that's pretty dangerous. So the golden handcuffs are the best way to do that. And you can do that through phantom stock. You can do that through key man insurance, key person insurance, depending on how you want to put it. Or giving them more paid time off, spend with their family. There's a number of different ways that you can go about keeping them happy. We did something for someone the other day where the person that was leading on a big project, she was spread pretty thin. And so we simply had the business owner pick up the cafeteria lunch bill for her 3 children that are in Catholic school that she didn't feel like she had the time to make their lunches every day, every morning. She's a single mother, and there's little things like that where just, okay, take a little bit of stress off of them, whether it's in the office or with their family life. Keep them happy.
There's more goodwill than anything else, right?
Absolutely.
Or their dollars. Yeah.
Right.
And Alicia, when companies come together, I have to assume that you've seen some of the friction, right? We pay our employee really well. Well, we try and get the least expensive. When those are coming together, what are some of the conversations you've seen between business owners and how they get on the same plane with that?
I think a lot of it is around just how you're going to retain those employees that are, like, to your point, are very good, and you can't risk losing them, especially in this environment when it's so hard to hire good talent. And so we see a lot of conversations around sharing in the equity, whether it is small tranches of 0.5% a year, just to get these folks bought into the practice and make it feel like they are going to be a part of the team going forward. That makes a huge difference. whether it's even training those folks to be, to learn how to take over the operations or to take over the financial aspect, and just spreading that work around so everyone have a say and feel like they're treated a part of the team going forward. Those are big conversations that we see going on right now, and we love to see that. We like to see the entire team bought in so that we, can have faith that the person that we're lending to is going to be around for the long run.
Right. And they'll retain the people. Yeah. Yeah. So, Raul, we've been talking about this. I feel like sometimes, again, especially in the financial planning aspects with the early stages of a business, the first and foremost is always the P&L, right? Which affects our employees, which affects how we're investing. But you've done this for enough years. You've worked with enough firms. Like, what are some of the most important things that people are missing about something as simple as the financial statements? What do they need to focus on more than just the L or the P&L?
It's a great question. The main thing that when I go into any kind of I don't know, most people don't know, I used to be an auditor. So when I went in to do an audit, I would be looking at not just their P&L, which most people just concentrate on P&L and balance sheet. Right. You know what? Those are two important parts of the financial statement, but your cash flow is also probably one of your major one. And most people disregard that. So you could have a great P&L, but you don't have cash to pay your bills. What good is your company at that point? So having the full set of financials is super important. And then on top of that, you want to make sure that you have the right chart of accounts. You want to be able to designate where things are going so that when you're putting together your financials, everything's in the right place. So I see that as being the major problem that most small companies do. They don't put enough time into thinking about what your business is, what my expenses are going to be, what areas do I need to put out there. The other most important thing would be separating your personal from your business. It's very important to make sure that you have your business accounts, your bank accounts, your credit cards, and use that just for the business, because if you start mixing, you're really opening yourself up to major problems.
So everyone here is a business owner, right? Does everyone know what they made last year in profitability? All right. Does everyone know what their monthly cash flow is as opposed to what they make on a monthly basis or what they report? Let's say that. So as advisors, we need to eat our own cooking, right? And we need to focus on those types of things. Good point on the personal versus business expenses. Does everyone here who's a business owner, all of you are, have a separate business account? Yeah? Okay. Just want to make sure no one was saying, no, I just throw everything through this and get all the interest and everything on that.
It's amazing how many companies you go into and they don't have a business credit card. They're just using their own personal credit cards and say, oh, just split it up at the end of the year.
It's a capital contribution at the end of the year, right? Right. So you've had to have seen this, Alicia, right? Where people are just, oh, no, my profitability is a lot higher. I just happen to put all of my kids' tuition on my business credit card because I'm going to hire them one day.
Yeah, I was laughing because everything he says rings true. It's not uncommon that, we'll look at the financials, we'll ask for the last 2 to 3 years financials and tax returns, and we'll look at the debt service coverage, the EBITDA. We look at the profit margins, and we'll look at the trends. And when, my underwriters or sales folks start asking those kind of in-depth questions, sometimes we just get the blank stares and they don't have an explanation. We want to understand that cash flow because that's how we're going to get repaid. And so, we really need and strongly recommend that they hire CPAs or, someone that can help them and advise them on that financial aspect so that when the time comes and they need a loan, that they're not stumbling around trying to answer those questions, because that's one of the reasons that we're going to decline a loan is if you can't explain the dips and the trends. And, especially the other piece is the performas. We're going to ask for performas and projections. And if you have these wild numbers in there and you can explain, well, I think this is going to happen and that's going to happen and it's not trending with everything else, and mixing in that personal, that's a big issue as well.
So in the PE world, we call that vapor banking, right? I think it's going to go straight to the moon.
Yeah.
So Dave, you work with a lot of these firms, right? As they're kind of growing, but also then preparing for an event, right? Be that a succession or could be anything. How do you see people working? Because thank you for bringing that up. By the way, Bristol Lane does that. How do you work with CPAs, as a consultant advisor to your clients? How are you working with their CPAs to help make sure that the business is healthy, okay, and doing the right things for that event?
So in most cases, I'm brought in by the owner, and a lot of times it's maybe because he's not happy with how things are going at the firm or at the business already. But it's important to be as humble and as supportive of the CPA or the CFO, whoever's in charge of the books, as you possibly can. If you haven't noticed, CPAs are a unique breed. In many cases, if it's not their idea, they don't think it's a good idea. And if you can build them up in front of the business owner, and full disclosure, most CPAs know more about the 1040 and the 60% of the tax code than I ever will. But my team only really focuses on maybe 10% of the tax code, 10% of the 80,000 page book. And, with the blocking and the tackling and everything, the CPA and the CFO are definitely going to know the ins and outs of that for sure. And so we really go out of our way to help build them up in front of the business owner. And then if there's a section of the code that maybe our team specializes in and they do it 365 days a year, then we, behind the scenes, we kind of coach up that everyday CPA or CFO, explain to them how we do it, how it's allowed, what subsection we need to reference in order to make sure it gets done cleanly. And then sometimes we even present it as a joint idea to the business owner.
Easier to sell.
Yeah, I mean, we wouldn't be there if the business owner didn't already trust us, but we don't need to go in like a wrecking ball and destroy some of his top talent or run them out. And so, like I mentioned to Raul earlier, kill him with kindness, right?
So again, we'll move into the kind of risk management of this, but again, what we're trying to focus on here are ways that you can add value to a client's business without having to be directly related to the assets that they own. More about how they're building their own. Typically, their largest asset, right, is our clients' businesses, for those entrepreneurs, for those business owners. But so let's just talk about risk management. We'll roll into that for a second here. So Alicia, I'm going to start with you. Risk management. You're about to lend to someone. It could be $1 million. It could be $10 million. What do you guys look at when you, on the risk side, when you're thinking about lending money to people?
So a couple things, and you're talking about sole business owners. I think that applies. So a lot of folks here that could be the sole practitioner in their own firm, and they need to, that is their retirement plan, and so they need to treat that as they would treat their clients' assets. And so, a lot of times things that we look at for risk factors are, do they have email life insurance? Do they have life insurance? So if something happens, and the loan is still outstanding, that we have the ability to pay the loan off. You would be surprised, or maybe not, at the number of advisors that you ask if they have life insurance and they don't have any at all.
How many people have life insurance on themselves here? Excellent. This is a great.
Yes, I love it. The other thing is they were making sure they have adequate D&O and E&O coverage for potential claims. And then I think, and I keep seeing this, so I'm going to mention it, is a big risk is, we'll look at the ADME and see if there's any disclosures. And for some reason lately, we've been seeing a pop in the disclosures. And some of the people that come to us, or even some advisors that we've had on the books, and something will pop. And that's definitely something you want to dig into. Sometimes there is a reason or rationale, or it's been quite a bit of, years have passed since the event occurred. But that's definitely something we're going to look at because it's all about the character. And then the risk also that we talked about a little bit ago was just the strength of the team and the bench behind that person.
That makes sense. How many people here have a PNC license? Okay. So just, I reference that only because what we found recently is a lot of advisors, you can be going out to your clients, talking to them about what are they doing for E&O, what are they doing for D&O. We have a partnership with a firm called Hub International. We work with them, and again, E&O and D&O, as a reminder, is just PNC business. So if you had a PNC license, or if you have someone that you partner with in that area, that is another area where you can be proactively talking to your clients, working on it. So we've heard a couple of times buy-sell agreements, right? So Raul, what at the heart of it, what's a buy-sell agreement, and how do you negotiate one, right?
Buy-sell is basically just an exit strategy. It's how am I going to get, if something happens to me as the owner, what happens to the business? So you use insurance mostly to cover that, like you were saying, key man insurance or whatever. But it's also, you got to think about the future anyways. So when you're starting a business, one of the first things you should think of is how do we close this up? What happens? I'm not going to do this for the next 100 years if I could live that long. So how do you get out? So that's what this buy-sell agreement's all about. It's how do we, if God forbid something happens to the main person, what do we do now? And it takes care of that problem.
So advisors can approach their business owners, and it doesn't have to be scary. It doesn't have to mean I'm losing control or I'm being forced to sell. It's really more of, I hate to use the term, but it's an insurance policy really for the rest of the firm, right?
Certainly, and it's just a policy or a plan for what could happen. It doesn't have to even be implemented. Got it.
Right. Just prepare.
Just a quick note on that. I might butcher my legal references on this, but I believe just last year the tax court came down with, I believe it's the Connor ruling, in that the life insurance being utilized to fund buy-sell agreements are now considered as part of the seller's taxable estate, which previously the legal community has been telling people for decades, oh no, this is outside your estate and you don't have to worry about it. But the court disagreed. And so when you structure the buy-sell agreement and the funding mechanisms for it, sometimes you're better off doing it maybe in a partnership structure. There might be a trust or two, maybe a grantor trust that's outside of your taxable estate that could own the policy, that could then buy out whichever partners are passing away. So, but double check that before you put that insurance structure in place.
Yeah. So and key man, key person insurance, depending on how you own it, depending on how you pay for it, depending on who the beneficiary is, all of those things trigger different taxable events. So Raul, if you can just talk a little bit, just really quickly about some of the ideas, because that's a great point, right? Now that there's new rules around this, there's new ways to take advantage of it. What are some of the just very, straightforward, consider this when you're buying it, consider loans it, consider as big for it?
Well, one of the things you have to worry about, and it's a good point that you brought up, if you're going to move it over to a different entity, where do you deduct then the payment of the insurance? Because now it's being paid by somebody else. So it's not an expensive company anymore. So you got to take those things into consideration as well. If you're moving things around, how does that impact your P&L, your financials? So you really have to think about the complex structure that you're trying to put together and know how that's going to impact what you're trying to do. So having the plan, thinking it out is paramount to knowing what you're doing is correct.
And I know there's a lot of smart people in here, and a lot of you are familiar with life insurance, but in a lot of cases, if you're deducting the premium going into life insurance, death benefit is no longer tax-free.
Right.
And so, to Raul's point, you got to navigate that carefully.
And I don't think most people, right, that we're advising know that immediately. So again, one of those things where we're trying to give you ideas of going back to the office and things that you can use immediately. One of those things is start going through your business owners, right? Start figuring out if they have a buy sell, what kind of protections they have, and just see some of the details around it. I think it'll be eye-opening. It'll definitely give you a lot more view into the business. All right, so let's move on. We've talked about risk. Now we're talking about growth, right? Everyone here wants to grow. You wouldn't be here if you didn't. So, Alicia, when a company approaches you guys, right, or approaches a bank in general, for financing, what are different types of subjective things you guys talk to them about, right? I mean, is it just purely financial statements, or are you looking for something else when you're doing your underwriting?
So we're going to look at a variety of things. So, like I said, financials are first and foremost, but we're going to look at the character of the person. We're going to take a look at their assets under management. So we're really going to dig into their book. And we're going to want to understand, what's the average client age, the retention of the clients, average household size. We're going to look at the organic growth and net new clients. And if those aren't headed in the right direction, that's going to raise some red flags. We're also going to look at the strength of the team. We're going to want to make sure there's not any concentration risk among clients, or if the client base is, the average age is 75, that's going to be some concern as well.
Right.
The other, subjective things that we look at, we're going to want to also, well, it's not really subjective, but we're going to ask about their business side and the operations. We're going to want to take a look at, do you have all your organizational documents? Do you have your copies of your stock certificates if you're a corporation? We're going to look at, do you have signed, which we were kind of chuckling outside, signed copies of your operating agreement? Do you have a buy-sell agreement or something in place if something were to happen? So, it's the whole picture that we're going to want to look at. We like to talk to the CFO, the CPA, whoever is handling those financials, if it's not the business owner themselves, and just take a look at that entire picture.
We found that going through that process, right? I don't know if there's anything more thorough that isn't health related than going through a plan to grow through capital, right? Through lending. So even we'll say financial solely join our parent company. Even we went through and found where we had to update operating agreements that were in place since 81, right? Since the firm started. So it's a process. It's one of those things that you can reach out to clients, right? Again, those that are looking to expand, and start talking to them. Let's see what you have. Do you have all your legal documents? And most will say, oh yeah, I'm good. But the answer is let's make sure that we're forcing them to take the time to think through that. So David, all right. Here's a question that I see a lot is, well, if I'm going to go out for a loan or capital or whatever, why wouldn't I just maximize how much money I get, right? Why don't I just take on the full amount of debt or private equity or whatever, so that I can have more money to spend or to invest? Like, how do you counsel a client on what's the right amount that they have to go out and finance?
Well, first of all, we spoke about pro formas previously, and so the debt service has to be sustainable, but also it's kind of a question as to what are the family dynamics or the business dynamics after you borrow all this money. Are you nearing the end of your career and maybe generation 2 is getting ready to step up and help out with the existing firm and the firm that you're trying to acquire? Do you really want to burden the next generation with all that debt servicing? What if the market goes down 20 or 40% and your quarterly fees decline in the same direction? And sustainable growth is always better than rapid growth, in my opinion. I believe I had a professor in college that said the top two reasons for small business failure is A, not enough growth, and B, too fast to growth. And so if you're borrowing too much and you're trying to grow too fast, that is a really easy way to burn out and crash the business.
Yeah, we've seen that for those, those companies that come up and they go to the moon. You hear about these people who are constantly raising capital, and the reason is not because they're not doing enough business. It might be because they're doing too much and they can't catch up with the growth rate in their cash flow.
And maybe when that loan is up for renewal, maybe the interest rates aren't what they used to be.
That's, yeah, 100%.
We've seen, whether it's a lot of property owners or business owners, refinanced, and let's say they borrowed during COVID at 2.5%. That 5-year renewal maybe is coming up really soon, and they're not going to be able to afford a 7% rate.
Yeah. So, Raul, looking at debt service, what do you typically helping your clients look at when it comes down to, all right, I'm going to take on this much debt, to help them with the decision making? What are the things that you tell them with that?
Well, you have to look at your cash flow.
Right.
Will you be able to make those payments? Like you said, if the interest rate goes up by double or triple, which could happen, is your market gonna give you enough cash to cover that? If not, you need to start thinking about maybe paying down the loan instead of renewing it, kind of thing, which means you might have to sell off, which causes tax problems as well. So it's a constantly changing and evolving situation, and the best answer is just be prepared.
So, how many of us have business owners as clients? I would say most of us, right? How many of you actually get the financial statements from their largest asset, which is typically their business? Okay. So again, one of those things, take home. Start that conversation. All right, this is the most important asset they have. Why are we not looking at that just like we look at the stock that we want them invested in, or the asset allocation? Right.
And Matt, yeah, there's also usually no less than 100 different golden nuggets in that balance sheet or income statement. Maybe they have a retained cash or retained earnings that they've been holding on to themselves and managing themselves, or maybe their banker's been managing. No offense to any bankers, but maybe the business banker is managing a portfolio under the company's name, and there could be millions in there. I came across one case where we were doing the valuation discount planning and estate planning for the owner. Well, his brother, who was the CFO, was managing, I believe it's about $8 million of retained earnings inside the family business. The business itself turned out, after I peeled everything back, the business itself was actually losing money. The interest and capital gains and dividends from the $8 million portfolio was what was paying their
100%.
their profits every single year for a decade.
So it's funny you mentioned that. We just looked at an opportunity to buy another broker dealer, and much smaller, handful of advisors, but they were making an ungodly amount of money because they kept all their cash in one of their own advisory accounts, and what it was throwing off from interest really outweighed everything else they did. So if you looked at something from purely metric standpoint, right, it's what do we always hear in the banking side as well? It's an EBITDA multiple. We'll give you 8 or whatever. Well, if you don't look and understand what is driving those metrics, it's a bad decision. Same thing happens for our clients, right? So helping them understand, and maybe even to your point, helping be part of that conversation of when they are looking for growth, when they are looking for mergers, when they're looking for acquisition targets, being able to go through that. So that's a great point.
And why are you working 60 to 80 hours a week running your business, right? And it's losing money when you could just live off the dividends?
Yeah. All right. So we'll keep moving here. I think kind of one of the most interesting things I think most people want to talk about is just, all right, exit strategy, right? We've got clients who are exiting And talk a little bit about succession planning. What are some of the ways that you're seeing small firms plan for succession plan, right? What practice management, mergers, sales, like how are you seeing small firms deal with the succession planning game?
I think I'll tell you, this is definitely one of our largest growing loan purposes today, and it has been for the last 2 years. I think one of the biggest things is getting someone to actually make a plan and realize that this is their biggest asset. I think, as you had said, they a lot of times advisors don't have their own retirement plan. They don't have a huge 401k. They don't have a huge any of that set up, and they're waiting on this liquidity event. And if they don't have it set out or documented properly, it's going to be a huge hit to their family at the end of the day. So need to make sure, one, they have proper people to help them, get that plan in place. And then when they come to us, what we're seeing a lot of is they want to bring on that next generation. And it's all about having that conversation. Do they have the next 2, 3, 4 people that want to come into and actually be a part of the ownership? Unfortunately, we've seen circumstances where some of these smaller firms, they've either not had that conversation and they just assume that the next generation wants to be an owner, and they don't. And so then they're left scrambling, or they don't even have those folks and they have to go out and try to hire them, which then adds additional time onto that. But we've been able to help a lot of these folks. Well, we can finance these younger partners buying in. If they're buying in 1%, we can lend the money directly to that junior partner, or whatever you might want to call them, that junior employee, to buy into the firm. And then they're paying the debt back through their distributions. And we'll take a look at all those metrics, compared to their debt to income ratio and things like that. But then that gives them, they're on the hook. The firm is just guaranteeing it in case something were to happen to that individual. But we structure it so that they are taking 100% loan for that buy-in. And we can do that over a multiple year period. And so that enables that individual to buy in without the firm having to self-finance it and take all that risk on their balance sheet.
No, that's a great point. Because I think a lot of people think that if I'm giving someone, equity, what does that do to me? Right? Go ahead.
Are you just referring to financial advisors with
Well,
that 100% financing?
we can do financial, it depends. So for CPAs and insurance agents, if we're doing the partner buy-in product, that we can do up to 100% financing for that partner buying product.
But like S corps that are typically, kids are in their 20s or 30s. They find out the kids don't want the business, but there might be a key employee that does want it and they don't have a lot of capital. Is that 100% financing?
Yes, so we can take a look at that as well. I'll say, and I can generalize, I'll say a majority of our partners that are buying in, they don't have a huge bank account, and that's why they come to us. They have a mortgage, they might have a student loan still, they have a couple kids, and they're still able to buy into the business. And matter of fact, we have one closing. It closed yesterday. Couple partners that had bought in over the last few years, junior partners, they had no liquidity or equity coming into it, and they have minority PE that's buying about 25% of the whole firm, and they're already realizing a liquidity event, partial liquidity, after just 3 years. So it's really neat, the things that we can do for folks to buy in. Now, it's not going to come without probably some sort of discount to the valuation, internal versus external. Talked to a guy last week. He said, look, I could probably get 150 million on the market, but I don't want to be greedy. I want to allow my junior folks to come in, employees, to buy into the business, and I'm discounting it to probably about 95 for the purposes of the buy-in. So, it comes with some sort of self-sacrifice, but at the end of the day, it's going to perpetuate that the way he wants to, and not selling out to private equity or something like that.
Yeah, we definitely see when we do valuations for companies, we definitely see the first thing you need to know is the mission. Because if it's to maximize profits, it's one approach. If it's to figure out how to do internal valuation to turn it over, it's another one. Simply because of that, right? Partial versus full buyouts. So 2 more questions and then we're going to kind of wrap it up. Raul, so I'm about to make $1 million on the sale of my business. What are some of the questions or what are some of the things that you like a business owner to think about as they're structuring that exit, as they're structuring that deal?
Well, I think the first thing you want to do is make sure that you have a good evaluation of the business itself. You say you're going to sell for $100 million. Is that truly what it's going to sell for? So getting an outside opinion of what the value of the company is key to figuring out what you're going to do. Then for structuring wise, it really depends on how the business was set up in the first place.
Right.
So if it's a partnership, then you could sell it as partnership. You could bring in a partner. You could remain like a silent partner. There's so many different ways. If it's an LLC, then you really start thinking about, well, an LLC is just a term for the most part. How is it taxed? Is it taxed like a corporation? Is it taxed like a partnership? Is it, is it an S corp? Is it a flow through entity? All these things you have to look at, and it really comes back to what I said at the beginning. Planning is everything. When you start a business, you need to plan for the future. And this is what we're talking about now, is we're now exiting out. We're bringing new people in. If you didn't set up your company in the first place to set you up for the future, then you're going to be scrambling at the end to say, okay, now I got to file all these tax forms to change the entity type so that I could then bring in partners, because I set myself up as an S corp or a C corp,
Right.
or whatever the case may be. So now you have to work scramble, and it brings on all these other tax consequences that you're going to run into. So planning is still the key.
Yeah. And a lot of times when we're counseling people who are selling their practices, one of the things that always surprises me is everyone thinks that I've been in the business for over a year, so it's all capital gains, right? Well, that's not really exactly how it works, because it's dependent on the deal. How much time am I spending? Am I holding a seller's note? A lot of that feeds into this. So it's not just him make $1 million. It's I'm going to make $1 million over 5 years, but I have to participate at this level. Some of that, the IRS is going to say some of that has to be ordinary income. So just those are the things to keep in mind and to keep business owners asking questions on. So last question, David. All right, someone's getting ready for that exit. Someone's getting ready for the next stage in their life. What's the key thing that you ask them, right, or to ask them to consider when they are doing that exit, right? What comes next?
Be honest and be patient. But really, when it comes to the patience, the more time we have to structure the deal or to restructure the company before sale, the better off everybody's going to be. With a lot of people in the room are probably familiar with qualified small business stock incentives. You could sell $10 million worth of shares for a startup that's existed for 5 years, tax-free. And so you need to start that process. Sorry, I'm not a CPA. I shouldn't be giving tax advice, but read the disclosures. But you got to start that process of converting maybe to a C corp 5 years beforehand, or structuring the deal, whether it's through an installment sale or an earnout or however, long before you're expecting these to take constructive receipt of those proceeds in order to maximize the tax benefits. And then most importantly is, how does it affect the family if it's a family business? Is there another generation coming up that wants to be in control, wants to take control? And we're working on a yacht company on the other side of Florida right now. There's 3 generations of family business of potential owners in the company, and they're trying to solve a lot of their issues with an ESOP. Yeah.
Ugh, okay.
And I'm a little late to the game, but I haven't unscrewed that pooch yet. But the attorneys and CPAs love it. because they'll get paid forever on it. But it just takes a lot, and making sure that the right advisors, the right professionals are in the room, and that everybody's on the same page.
Perfect. So again, in the idea of you guys being able to take things away, right? If you go one more. There. This is just a quick and dirty checklist, right, of things to think about as you're doing financial planning with clients. And when I say financial planning, I mean financial planning that we talked about for our business owners, right? That's number one. Number two is if you stop out at the Bristol Lane table, we have a piece that was provided to us by Alicia and her team, just walking through things to think about and things to have prepared when you're getting ready to capitalize, right? So just another checklist that you can take your clients through. Third, we'll probably have it up on Peak Link here, but David has been gracious enough to share what he works on or what he uses with clients as he's preparing to help them. And then lastly is because, again, we believe that you getting closer to people's largest asset, right, their businesses, is of the utmost importance. Jack Alvosa, since he's been here, has been working on financial planning agreement that you guys can all use with your businesses, so that it's not about, financial planning from an investing standpoint, but it is using these tools. And what I'll say in with that is one of the requirements of that is making sure that you have those people in place, like the folks up here, who can help you through that process and help your clients through that process. So if there's questions, let us know, right? If there's questions about what I can and can't do, obviously Jeff is going to be very helpful in that. But our goal is really to help you guys go out there and be able to do more business with your current clients and listen and talk to them. Okay. So I know that we're at the end of the time, but are there any questions here that would be good for the whole group?
Should we and I'm coming back from when the first I met your office.
Sure.
You mentioned something about a little bitty, our family office.
Yep.
With the crew.
Mhm.
Is that still a reality? Is that, do we have access to you guys through certain channels?
Yes.
And that's what I need.
Yep. So we talked about it a little bit yesterday. What I'll do is I'll follow up with you. But what we found is that, I don't know about you guys, everyone that I've talked to here is willing to share and help each other, right, in their specialties, right? The group here who flew in for this, right? But yes, we do have those capabilities. It ends up being dependent on what it is that you want to do for and around those families. And then we just bring the right team members. Okay. Great. Thank you guys. Thank you for being on attentive.